Bond pricing is a process of determining the fair value of a security. Market participants are interested in calculating either the effective yield, given the price at which the bond is trading, or the market price equivalent given a specific yield requirement. Of course, in practice, the bond price is a market price. But how is the theoretical fair value of the bond calculated in the first place? The value is a present value of expected future cash flows. Therefore, to value bonds, we need to estimate those future cash flows both in terms of size and timing, and discount them at an appropriate discount rate. Once a value has been determined, the sensitivity of the price can then be estimated along with the various yield metrics which relate the price of the bond to its coupon or cash flows. The generic formula can be applied. Note, since the price is the present value of the cash flows, there's an inverse relationship between price and discount rate. The higher the discount rate, the lower the value of the bond. We will expand on this relationship in a moment. But what discount rate should we use? Market convention is to use the yield to maturity. But remember, if we are analyzing a risky security, we need also to include the appropriate credit spread to the risk-free rate of return. Therefore, a credit-sensitive security is typically priced relative to a benchmark, usually a government security. The higher the quality of the credit, the smaller the spread between its required return and the yield to maturity of the benchmark. This required return is then used to discount the bond cash flows to obtain the price. It should also be noted that the generic formula will only lead to an accurate result under the following assumptions. Firstly, all cash flows are discounted using the same interest or discount rate regardless at which point in time they may occur and ignoring the realities of a term structure of interest rates. Secondly, it is assumed that all future cash flows are automatically reinvested at a constant rate equal to the yield to maturity. This is not to say that any resulting price is wrong, since it is market practice to quote on a price basis, but the derived implied yield will only be realized under the unlikely conditions that reinvestment of all future cash flows could be made at the yield to maturity. So, what relationship exists between discount or interest rates and the bond price? As mentioned earlier, a basic property of a bond is that its price varies inversely with yield. The reason for this is straightforward. As the required yield increases, the factor by which future cash flows are discounted also increases, and therefore the present value of the cash flows must decrease. Hence, the price decreases as yield increases. Conversely, when the required yield decreases, the present value of the future cash flows increase, hence the price increases. This leads to a nonlinear price-yield relationship, meaning that the price sensitivity of a bond to changes in yield is asymmetric. For example, the percentage increase in price when yields decline is greater than an equivalent percentage decrease when yields rise. In short, prices increase at an increasing rate as yields fall, and decrease at a decreasing rate when rates rise. The sensitivity of a bond's market price yield movement is measured by its duration, here shown as a red dotted line, and additionally by its convexity. Duration is a linear measure of how the price of a bond changes with respect to yield changes. It is approximately equal to the percentage change in price for a given change in yield, and may be regarded as elasticity of the bond's price relative to interest rates. You will note that the further you move away from your initial yield, the estimated new price becomes progressively less accurate due to its curvature. A useful rule to remember here is that price sensitivity or duration will underestimate price changes as yields fall and overestimate price changes as yields rise. The convexity is a measure of the curvature of price changes and is thus a complement to duration. The necessity for this additional measure arises since, as already discussed, duration is a linear measure, whereas in reality, the price is a convex function of interest rates. Once we know the convexity of a bond, we can use it to adjust for any inaccuracies in the linear relationship we just discussed. When analyzing the price sensitivity of a bond, it becomes apparent that it is neither consistent nor constant and depends on a number of factors such as the maturity, the cash flow structure, and the yield to maturity. Let us first examine the effects of maturity. It is fair to say that the longer the life of the bond, the more sensitive is its price. Again, a function of the time value of money. However, it is important to note that price sensitivity does not continue to rise indefinitely as maturity increases. Price sensitivity is not infinite. The sensitivity of a 30-year bond is similar to that of a perpetual. This can be understood by looking at the mathematics and the effects of discounting. So what about the cash flow structure of the bond? The lower the coupon of a bond, the more sensitive is its price. Again, this makes intuitive sense, for when a bond pays a higher coupon, the holder of the bond receives repayments at a faster rate. Compare a high coupon bond to a zero coupon bond with the same remaining life to maturity. The latter is going to be far more sensitive since all the cash flows are paid at maturity and present valued at this point in time. Finally, how does yield affect the sensitivity on bonds? The lower the yield to maturity, the more sensitive is the bond price. A similar argument to the one just discussed, but again can be understood intuitively. As yields decrease, all of the present values of the future cash flows increase as the discount factors increase, hence greater sensitivity. As yields rise, the opposite will occur and bonds become less sensitive. The two major yardsticks used to calculate bond sensitivity are Macaulay's duration, which is more a qualitative ratio, and modified duration, which is a quantitative metric. Let us first look at Macaulay duration. It broadly corresponds to the length of time before the cash flows of a bond are due to be repaid. In other words, the speed of payment of a bond expressed in units of time or years. As such, it is useful for matching asset and liabilities and in constructing bond immunization strategies. How is it calculated? It is the weighted average maturity of a bond, where the weights are the relative discounted cash flows in each period. If the security pays a single cash flow at maturity, then the duration is equal to the maturity. Otherwise, the duration is less than the maturity. Therefore, one can easily come to the conclusion that the longer the duration is, the higher the interest rate sensitivity must be. It is therefore a useful metric that allows us to compare the relative risks of bonds with different coupon structures and different maturity schedules. Although it will not be able to provide a reliable estimate of the impact of a small move in yields on the P&L of a portfolio. Still, duration can be used by the bond investor to implement an investment strategy. For example, if the investor believes that market yields are going to decline, the investor may wish to alter the bond mix to include bonds carrying higher duration in order to leverage the increase in portfolio value. Alternatively, if an increase in yields is expected, the investor may wish to change the mix to include bonds of lower duration to minimize the negative P&L effects on the portfolio. However, Macaulay Duration will not be able to estimate the P&L impact and as such is incomplete. Modified Duration, however, estimates the proportional change in value of a bond due to an absolute change in yield and therefore produces a more accurate estimate of bond price sensitivity. It is easily calculated by taking the Macaulay duration and dividing it by the bond's yield to maturity. Note that modified duration is negative since it is calculated under the assumption of a given percentage rise in yields. Therefore, it is an estimate of loss if such a situation occurs. In addition to providing a mechanism to match the duration of assets and liabilities, we use modified duration in the management of risk and as a tool to facilitate the hedging of interest rate sensitive instruments. What is the difference between modified duration and price value of a basis point, or PVBP, which is also referred to as PV01 or DV01? This metric uses modified duration to estimate the actual monetary change in the price of a bond if the yield changes by 1 basis point. We can also draw the conclusion that the higher the PVBP, the higher the volatility. This price volatility is the same for an increase or a decrease of 1 basis point in required yield. Note that this holds true for only small changes in yield, since there is the additional effect of convexity. A further drawback is that such analysis depends on parallel shifts within a flat yield curve. In reality, this is not correct, and more complex multi-factor models are needed to actually risk manage bond portfolios. However, such simplifying assumptions allow one to quickly and easily compute risk factors which describe the sensitivity of bonds to interest changes. Let us look at an example. You own a 3-year bond with a face value of 100 million euros that currently trades at a price of 98.63 with a modified duration of 2.761. How much will you lose if yields rise by 1 basis point? To get the answer, we simply have to multiply the change in yield, in this case 1 basis point, by the current market price of 98.63, multiplied by the modified duration of minus 2.761, multiplied by the face value of 100 million euros. Therefore, for a small upward change in yield of 1 basis point, the bond will lose an equivalent of 27,232 euros. So, modified duration indicates how the bond price of a bond will change for small changes in yield. However, for large changes in yield, two bonds that have the same yield and the same modified duration can behave quite differently. This is due to the error in using modified duration, as already discussed, and is exhibited in the curvature in the price-yield relationship. Convexity is also positive related to duration and is generally thought of as desirable, and investors may give up yield to have positive convexity. Why is that the case? In general, a more convex bond will outperform in an environment of falling yields and will underperform less as yields rise. Furthermore, the convexity effect is asymmetric. For a specified fall in yields, the price rise taking into account the convexity will be greater in magnitude than the price fall related to the convexity factor for the same rise in yields. Convexity can therefore be associated with a bond's potential to outperform. Convexity is also useful for comparing bonds. If two bonds offer the same duration and yield, but one exhibits greater convexity, changes in interest rates will affect each bond differently. A bond with greater convexity is less affected by interest rates than a bond with less convexity. Also, bonds with greater convexity will have a higher price than bonds with lower convexity, regardless of whether interest rates rise or fall. Let us conclude with a summary of the price sensitivities. Which bonds offer high sensitivity to yield movements? Low coupon bonds, longer dated structures, and fixed income bonds in a low market yield environment. Which bonds offer low sensitivity to yield movements? High coupon bonds, shorter dated structures, and fixed income bonds in a high market yield environment. Also note that floating rate notes, or FRNs, are relatively interest rate insensitive.